A lot of news and data coming out of China at the minute, and I'm joined by senior economist at Roubini Global Economics, Daili Wang, to see what these events mean for the world's second largest economy. Daili, there has been a variety of important economic data out for China this week. Inflation rate, balance of trade, retail sales are just a few to name. What are they indicating for China going forward?
I think the general picture for China today is not whether China will slow down or not, but how long can China slow further? And my answer to this question is, it's not that far. The landing strip is already inside, and we may very likely to see the bottom of the acceleration quite soon. So for one thing, the economic growth in May is quite weak. There's one data on the Bloomberg said calculated the implied GDP in between February to May is only 6.5%, which is quite low, below the 7% growth target set by the government. However, we should look at a silver lining behind this weak data. So I'd like to give some examples. First, if we look at the trade data, especially the import growth data, we'll find that the deceleration in import growth is mainly a result of the lower oil price and lower commodity price. Volume basis, the deceleration is not as severe as it looks to be. Second, if we look at the CPI data, yes, it has decreased to 1.2% from 1.4%. But if we're looking at the non-food core CPI, it has increased by 0.2% on sequential month basis. And then looking at the fixed asset investment, which has just released 1 hour ago, we found this fixed asset investment decelerated to 11.4% from 12%, which is a bit lower than our expectation. But however, looking at the private investment, particularly the manufacturing and the real estate investment, they're still improving. So based on all this, we think the economic downturn will likely end, and we would like to see a rebound in the second half of this year.
And what will all this mean for future Chinese monetary policy? What is the dynamic in regards to policy?
Policymakers have two options. One is monetary policy, another is fiscal policy. My sense is that Chinese policymakers might opt to put less of the onus on the monetary policy and try to implement a more expansionary fiscal policy to offset economic slowdown. If we're looking at the credit data recently, we will see that the total social financing and the renminbi loan, they have actually decelerated rather than accelerated, even after 3 times of triple R cards and the rate card. So that is to say the monetary policy is not as effective as the policymakers hoped. And the evidence to support a more expansionary fiscal policy could include the State Council, which has just announced a new debt swap program that amounts to 1 trillion RMB, and also the National Development and Reform Committee. It has announced around 500 billion RMB infrastructure investment. So that supports my view that the Chinese policymakers were unlikely to use further or cut rates, but rather they will try to prop up the growth by expansionary fiscal stimulus.
And for now, MSCI is holding off on including China-listed shares in its emerging markets index, as worries persist about the openness and functioning of the country's exchanges. Do you think these issues will be resolved anytime soon?
Yes, so we know that the MSCI just decided not to include the Asia market into its MSCI Emerging Market Index. And the main reason for it to exclude the Asia is because the Chinese market is less liberalized and the foreign investors have no access to the market. I don't see in the short term that the MSCI will change their decision, because I don't think China will speed up the capital account validation reform and other reforms that could lead Asia into the MSCI index. From a cost-benefit perspective, there is no benefit for foreign investors to invest in Asia, because they already have access to the Asia. And the Asia market is in Hong Kong, and it has the same group of Chinese listed firms. There's no need for them to push forward to add the Asia into the index. And for the Chinese market itself, it has excessive liquidity rather than short of liquidity. So even if there's no foreign funds flowing into the market, there will still be stock market rally ahead. And from a cost perspective, if China wants to push forward further reform, that could inevitably weigh on growth. Let alone some reforms might even undermine the financial stability. So based on all these, there's no or very few chance that the Asia market will get added into the MSCI index.
That's all from Daili and myself for now. Thanks for tuning in, and be sure to keep clicking back to Dukascopy TV. Bye for now.